we continue to see this global bond rout. What does that mean for valuations, and has your view on your allocations changed since we've now seen the yields continuing to surge?
Well, it is starting to change a little bit. For the first time, I am getting a little bit nervous about parts of the growth trade, of course. Not because I think that yields are going much higher at this point. I think that the problem we're having is that the risk of a policy mistake is rising. The reason I say that is because typically we have divergent voices in policymaking committees and the FOMC, et cetera. It seems like from that last presser that we had following the last FOMC meeting that there is a widening divergence about what the problem actually is. And if you don't know what the problem actually is, it means it's a little bit harder to address it. For example, are we at full employment or not? Is inflation structural or not? Is this about loose monetary policy that needs to be tightened, or is it something else? I think that because we don't know what the issue is, it's going to resort to something where the Fed goes after what they know best, which is raising rates to address inflation historically. And if that's not the issue, then we're going to get a kind of dripping in of higher rate expectations until we push the economy into a recession. That's the fear, and I'm fearing that other monetary authorities are going to try to get ahead of the Fed and not be a passenger. So that's the worry here. Whether
or not we know what the problem is, we do know that the symptom is rising prices. Can you play that?
You can, and I think that that's what you should do at this point. Even though I think that the drivers of inflation right now are not traditional monetary drivers, it doesn't really matter in the end. I think that this inflation sensitivity is something that's going to be a theme for some time, and right now, finding opportunities to come back into to oil stocks, for example, into industrial metals, that works. I wouldn't go all in every cyclical rate-sensitive trade, though. I am still a bit worried about financials, as I think that there is potentially a growth issue and a profit issue in driving lending in this kind of a market where rates are rising. So it's not all in on rate sensitivity, but rather on inflation sensitivity, I think, is a better way to play it.
The inflation outlook carrying through just to the extraordinary sustained exuberance across not just crude markets, but of course pretty much every single commodity you can name. Does that mean you're still positive on some of these companies to be able to extend some more gains?
Well, I think that that's what we have seen. Through this earnings season, we have seen that where companies have a plan to address inflation, where they can pass through prices, even if they have a bit of a challenged outlook and they're giving some guidance on how they're going to address it, the market's been actually just fine with that. This is an environment where if you just guide down and say, I'm a passenger to inflation, then you have been punished a bit. And that is the divergence here. Earnings season has been great on a top and bottom line perspective, but as we've seen from some of the market reaction, it's not enough here like it has been for the past few quarters. Investors want to see a plan.